Hello and welcome. In this video, we will learn what happens when a well-known private company decides to list itself on the stock market. Alright? And for us to learn this, I will take two cases. Case number one is that we have already learned about. And so, I will quickly recap it. Okay? We have two friends who want to start a company or an industry or a factory which manufactures coconut oil. The people who start the company are called promoters. Okay? Now these promoters have calculated that they need 10,000 rupees to start the company. Person A, this person, has 4,000 rupees and says that he wants to contribute to the company. Person B has 2,000 rupees and says that he will give it to start the company. They need 10,000 rupees. They pool 6,000 rupees and still 4,000 rupees is required to start the company. Okay. Now, they go to a bank and ask for a loan, and the bank says that it can give a maximum of 2,000 rupees. Okay. So, the money they take from the bank is called as debt. Alright. So, now they have 8,000 rupees and 2,000 more is required. So, what do? They split the company into 4,000 shares of 2 rupees each. Now, this price is arbitrarily set by the promoters of the company. Okay? There are no set rules to set this price. Alright? After they split the company into 4,000 shares, person A and person B keep 4,000 rupees worth and 2,000 rupees worth of shares, which is 2,000 and 1,000. Okay. Rest is offered to the public through an IPO. So 1,000 shares are bought by the public and they get their 2,000 rupees, which adds up to 10,000 rupees, and then they start their company. Okay. This is the first case which we have already learnt about. I made this example simple so as to explain you the concepts of the stock market. Alright. In reality, this is not how a company goes for an IPO. This is not how a company operates. Okay. So we will go to the second case which depicts the reality of going for an IPO. Alright. Same case where the friends want to start a company or an industry. They need 10,000 rupees. Person A gives, or promoter A gives 4,000. Promoter B gives 2,000. 2,000 rupees is taken from the bank and they still need 2,000 rupees more. Alright. Now, instead of splitting the company into 4,000 shares, they split the company into 3,000 shares. Alright. Promoter A then keeps 2,000 shares and promoter B keeps 1,000 shares. Alright. So 2,000 plus 1,000 is 3,000. So the entire equity is owned by the promoters now, or 100% of the shares is owned by these two promoters. They do not go for an IPO. they do not sell the shares to the public. Alright, so the public doesn't own anything. Alright, now the company is started using 8,000 rupees capital. They needed 10,000 rupees. They were able to adjust only 8,000 rupees, and so they decide to start using 8,000 rupees only. Maybe less machinery, less workforce, or less production. Alright, so they start using 8,000 instead of 10,000, and there is no shares to the public. Alright, over the next 5 years, they work very hard. The promoters work very hard to establish the company, to market their product, to sell their product. And after 5 years, the company is in profit. Okay? Company is in profit. Now the profit is reinvested into the business after taking dividend and paying interest to the bank. Now whatever profit they get or they are getting in their business, they keep some of it to themselves. Why? Because they have invested 4,000 and 2,000. Correct? The promoters. They have invested 6,000 rupees, and so they are keeping some part of the profit as dividend to themselves. We will learn about dividend later in detail. For now, just know that it is a part of profit which the shareholders keep for themselves. Okay? And then they have taken 2,000 rupees loan from the bank. Correct? So they will have to pay interest every year. So from the profit, they pay the interest and they maintain the loan. They do not want to repay the entire loan for whatever reasons. Alright? And the remaining money is reinvested back into the business. Alright? Now, after 5 years, the worth of the company is 8,000 rupees. Alright. So how much was it before? It was 6,000 rupees plus 2,000 rupees loan from the bank. It was 6,000 plus 2,000. Now it is 18,000 rupees plus 2,000 rupees loan from the bank. So 6,000 worth has become 18,000 now. Alright. Next, the shares cost rupees 6 each. When they had split the company into 3,000 shares, it was priced at 2 rupees each. Right? After 5 years, due to all these profits, the price of a share is 6 rupees. Now, where is this 6 rupees? It is in the account book or in the book or on the papers. Alright? Because they are not trading it. The shares are not listed on the stock exchange. It is just in the account book. Okay? The shares cost rupees 6 each in the book of accounts. Alright. Now they want to expand their company. They want to build a bigger factory, or maybe they want to build more factories in different cities or different states, or maybe they want to export their product into or to other countries by producing a larger amount. Alright. Or in simple words, they want to expand their company. And to expand their company, they need more money. And so what they do is they decide to create 1,000 shares and offer it to the public through an IPO. Alright. So this in reality is how a company goes for an IPO. Okay. There are a lot of conditions or requirements to be fulfilled by a company before going for an IPO. And some of them are these. Okay. The company must have existed for at least 3 years. It must have made profits in at least 2 years, and it must have a minimum net worth of rupees 3 crores. Alright. Now, let us say that the oil mill has satisfied all these requirements. Okay, all these requirements. Now, the next question is, at what price should they offer their shares or the shares of the company to the public? The industry is up and running, right? It is already established. They have clients, they have business, they are making profit, and now they want to expand their company. So at what price should the share be offered or the shares be offered to the public in an IPO? Let us answer this question now. Let us say that the face value is 2 rupees. Okay, face value of a share is 2 rupees. What is face value? Face value is the value of a share on a share certificate. Alright. So when you buy a share, you get a share certificate. And whatever price is on the share certificate is called as face value. Okay. Or in other words, whatever price the share was sold initially is the face value of the share. Okay. Now when we deal in the market, we do not have to worry about the face value because we do not take this into consideration at all. It is the book value and market value that matters, which we will see in some other video. Alright. Let us say that for now the face value is 2 rupees. That is the price at which the shares was offered initially and it was bought by promoters. Correct? Now, if they want or if the company wants to offer shares in an IPO, they will offer it at a price which is equal to this 2 rupees, which is the face value, and a premium. Okay. So 2 rupees plus a premium. And let us say that the premium has come to 14 rupees in our example only. Okay. So what is this premium and what does it depend on? This premium depends on many factors. Alright. What are the factors? Let us look at them now. First is book value difference. Rupees 6 minus rupees 2, which is rupees 4. What is this 6 rupees? 6 rupees is the price or worth of a single share right now. I told you that the worth of the company is 18,000 rupees plus 2,000 rupees, right? And the worth of each share is 6 rupees, correct? So 6 rupees minus 2 rupees. What is 2 rupees? Face value. So 6 rupees minus 2 rupees is 4 rupees. Alright. So plus 4 rupees. Next is brand value. The industry or the company is already established. It has a brand name and the brand name has a value, and so add plus 5 rupees. So 4 plus 5 is 9 rupees. Okay. The company is already established or the business is already established. It is up and running smoothly and they have loyal clients or buyers. So for that, plus 2 rupees. So 4 plus 5 plus 2, 11 rupees. Okay. And then future prospects. That is, in the future, the company will do good. Alright. Because the promoters are confident, they have demand for their product, they have loyal clients, and they expect their company to grow. So plus 3 rupees. And now it is totally 14 rupees. 4 rupees plus 5 plus 2 plus 3. It is 14 rupees. Alright. 2 rupees is the face value. Premium is 14 rupees. So at 16 rupees, shares will be offered to the public in an IPO. Alright. Now, whatever I have explained here is hypothetical. This is a massive oversimplification. In the real world, investment bankers and company officials don't just assign and add up simple rupee values for abstract concepts like these. Okay. IPO valuation is a complex process that involves methods like comparing the company's earnings to those of similar already listed companies, projecting the company's future cash flows and calculating their present value, assessing the market value of the company's assets, and much more. Alright. So that is how an IPO will be evaluated or evaluated, and the price of a share will be fixed. Alright. This was my attempt to make the concept simpler. Okay. And this is how a company goes for an IPO. Alright. They operate for a few years and then they go for an IPO when they want to expand. Alright.